What is probate in Florida and why you should avoid it? This video is for educational purposes only and does not constitute tax or legal advice. Imagine this. You've spent your entire life building wealth, a Florida home, investment accounts, maybe a business. You have a will. You've done what most people never get around to doing. And then you die, and your family spends the next 18 months tangled in Florida courts, paying attorney's fees, watching private financial details become public record, and waiting, just waiting, to receive what you always intended them to have. This is probate, and for high net worth Florida families, it is one of the most costly mistakes in estate planning. Although it is very difficult to completely avoid probate, the time and expense can be significantly reduced with proper planning. Today, I'm going to show you exactly what probate is, why Florida's process is particularly burdensome, and most importantly, what sophisticated families are doing to avoid it entirely. Let's start with the basics. Probate is the legal process through which a deceased person's estate is administered under court supervision. When you die, someone has to be responsible for identifying your assets, paying your debts and taxes, and distributing what remains to your beneficiaries. If you have a will, probate is the court process that validates that will and oversees the distribution. If you don't have a will, what Florida law calls dying intestate, probate still happens. The court simply follows Florida's default distribution rules instead of your instructions. Either way, probate is a court proceeding, and that means it is slow, it is expensive, and it is public. Here is how Florida probate typically works step by step. First, a petition is filed with the probate court in the county where the deceased resided. In most cases, this is filed by the personal representative named in the will, or if there is no will, by a family member seeking to be appointed administrator. Second, the court validates the will and formally appoints the personal representative. This is Florida's term for what most states call an executor. Third, the personal representative must identify, inventory, and formally value all probate assets. For a complex estate, this alone can take months. Fourth, notice must be given to creditors who have a period, typically 3 months, to file claims against the estate. Fifth, after debts, taxes, and expenses are paid, the remaining assets are finally distributed to beneficiaries. And sixth, the estate is formally closed with the court. From start to finish, a straightforward Florida probate takes a minimum of 6 months. Complex estates, those involving businesses, real estate in multiple counties, disputes among beneficiaries, or significant tax issues, routinely take 1 to 2 years or longer. Florida probate is not like probate in every other state. There are specific characteristics of Florida's process that make it particularly important for residents, especially high net worth residents, to plan around. Let's walk through the 4 biggest problems. Florida allows attorneys and personal representatives to charge fees based on a percentage of the gross estate value, not the net value, but the gross. That means if your estate holds a $5 million portfolio with a $4 million mortgage, the fees are calculated on $5 million. Most probate proceedings are referred to as a formal administration, and you must use an attorney. For larger estates, These statutory fees can amount to tens of thousands of dollars, and that doesn't include extraordinary fees for complex matters, tax issues, asset sales, litigation, which are billed separately and can dwarf the base fees. Florida law requires a minimum 3-month creditor claim period. That clock doesn't even start until proper notice is published and served. Combined with court scheduling delays, inventory requirements, and tax clearances, most estates will take on average a year to fully close. During that time, your family may have limited access to estate assets. A surviving spouse or adult child waiting on inherited funds is waiting because a court says so, not because there's any real dispute. This is the one that surprises most high net worth families the most. Florida probate is a public court proceeding. Your will, once filed, becomes a public document. Anyone can walk into the courthouse, or in many counties, simply search online and see exactly what you own, what your debts were, and who received what. For wealthy families, this is not just uncomfortable. It creates real risks. It can attract creditor claims. It can expose family dynamics to unwanted scrutiny, and it can invite litigation from disgruntled relatives or estranged family members. If you own real property in more than one state, say a Florida primary residence and a vacation home in North Carolina, your estate may require separate probate proceedings in each state. This is called ancillary probate, and it compounds every problem we've already discussed. For families with multi-state real estate holdings, this is a significant planning issue that a well-designed estate plan addresses before it becomes your family's problem. For example, many states consider an interest in an LLC an intangible subject to the probate process in the decedent's state of residence. Therefore, real estate owned by an LLC may only have to be probated in Florida for a Florida resident. Here is something critically important that most people don't understand. Not all of your assets go through probate. Whether an asset goes through probate depends entirely on how it is titled and whether it has a valid beneficiary designation. Assets that typically do go through probate include real property title in your name alone, bank accounts or investment accounts with no transfer on death designation, personal property, vehicles, jewelry, collectibles, art, and any asset that passes under the terms of your will. Assets that typically do not go through probate include assets held in a trust, whether revocable or irrevocable, retirement accounts with valid beneficiary designations, life insurance with named beneficiaries, bank accounts with payable on death designations, investment accounts with transfer on death designations, and assets held in joint tenancy with right of survivorship. Now here's where high net worth families make one of the most common and costly mistakes in estate planning. They assume their beneficiary designations are current and correct. They may not be. A common example is a former spouse as the beneficiary on a life insurance policy. Clients whose retirement account beneficiary is a parent who died years ago. People whose adult children are named directly instead of through a trust, triggering unnecessary tax consequences, or a minor child causing the asset to remain under court supervision. Your beneficiary designations are not covered by your will. If your will says one thing and your beneficiary designation says another. The beneficiary designation generally prevails and can lead to litigation, or an operating agreement or buy-sell agreement could trump the will as well. So how do sophisticated Florida families avoid probate? There are 4 primary strategies, and the right combination depends on the size and complexity of your estate. This is the foundation of probate avoidance for most high net worth Florida families. A revocable living trust is a legal entity you create during your lifetime. You transfer your assets into the trust, real estate, investment accounts, business interests, and the trust holds them on your behalf. During your lifetime, you retain complete control. You can buy, sell, change, or revoke the trust at any time. For all practical purposes, nothing changes about how you manage your assets. But when you die, assets held in a trust pass directly to your beneficiaries according to the trust terms, with no court involvement, no probate, no public record, and no waiting period. For estates with significant real estate, business interests, or privacy concerns, the Revocable Living Trust is almost always the right centerpiece of the plan. For assets that can't easily be transferred into a trust, like certain retirement accounts, naming proper beneficiaries keeps them out of probate entirely. Florida also allows transfer on death designations on real property through what's called an enhanced life estate deed, also known as a Lady Bird deed. This allows real estate to transfer automatically to named beneficiaries at death without probate and without losing homestead protection during your lifetime. Assets held in joint tenancy with right of survivorship pass automatically to the surviving joint owner at death. No probate required. This is commonly used between spouses for primary residences and joint bank accounts. However, for high net worth families, joint ownership comes with significant risks, gift tax implications, creditor exposure, and loss of the step-up in basis that must be carefully evaluated before adding someone to title. This is a strategy that sounds simple but requires professional guidance to implement correctly. Florida provides simplified administration procedures for smaller estates, those under $75,000 in probate assets. These are called disposition, without administration, and summary administration. For most high net worth families, these thresholds are irrelevant for the primary estate. However, they can be useful for addressing assets that inadvertently fall outside the trust, a situation we call trust funding gaps, without triggering full probate administration. Here is the single most important thing I want you to take away from this video. Creating a revocable living trust is not enough. A family pays an attorney to draft a beautiful revocable living trust. It sits in a drawer, and when the client dies, their bank accounts still have no beneficiary designation. Their investment accounts were never retitled into the trust. The result? Full probate. Despite having a trust only controls the assets that are titled in the name of that trust. If you never transfer your assets into the trust, a process called funding the trust is an empty vessel. Your estate still goes through probate. Proper trust funding means retitling real estate into the trust name, which in Florida requires a new deed recorded with the county. It means changing the account registration on your investment accounts to reflect the trust as owner. It means coordinating beneficiary designations on retirement accounts and life insurance policies to align with your overall plan. Now, technically, your homestead is not a probate asset in Florida, but the rules regarding homestead will be discussed in a future video. This is ongoing work. Every time you acquire a new asset, a new property, a new account, a business interest, it needs to be evaluated for how it fits into the trust structure. The families who successfully mitigate probate are the ones who treat their estate plan as a living system, not a one-time transaction. Let me leave you with this. For a high net worth Florida family with a properly funded Revocable Living Trust, coordinated beneficiary designations, and a thoughtfully structured estate plan, probate can be significantly reduced. Your family should not have to spend 18 months in Florida courts to receive what you built for them. With the right plan in place, that transition can happen in weeks, privately, efficiently, and exactly according to your wishes. If you found this video helpful, please subscribe to the channel, like this video, and hit the notification button. Every week, we break down advanced Florida tax and estate strategies specifically for high net worth families. And if this video would help someone in your family start this conversation, please share it. Estate planning works best when the whole family is informed. See you in the